to my channel. Before we proceed, I'm not a financial advisor and this video is for educational purposes only. The only information provided should not be considered as investment advice. It's essential you consult with your financial advisor or conduct your own research before making any investment decisions. Thank you. So let's dive straight into the video. So I want to talk about the crucial aspect of investing that gets often overlooked. The importance of smart money habits as an investor. You know, it's easy to get caught in excitement of potential high returns and overlook the fundamentals that can make or break your long-term financial success. But the truth is, 90% of investors fails to achieve their financial goals, and it's often due to poor investing habits rather than lack of knowledge about the stock market. So in this video, I'll be discussing the common pitfall that investor feels and the index funds you need for 2026 to help you build a solid foundation for your investment portfolio. To start, let's look at why most investors struggle to achieve their financial objective. One major reason is lack of well thought out investment strategy. Yeah, many investors jump into the stock market without a clear plan, hoping to make quick profits or follow the latest trend. However, this approach often leads to impulsive decisions, causing investors to buy high and sell low, which can result in significant losses. Another reason for high failure rates is the inability to control emotions. Investing in stock markets can be emotional, and it's easy to let fear, greed, or anxiety dictate your decision. When the market fluctuates, investors may panic and make rash decisions, such as selling their stock or selling their stock at loss or holding on to losing position for too long. Furthermore, many investors, they fail to diversify their portfolios, putting all their eggs in one basket. This can be devastating if the market takes downturn or a specific stock experience. Sorry, or the market experienced a significant decline. To avoid these common pitfalls, it's essential to develop smart money habits, such as creating a long-term investment plan, setting clear financial goals, and maintaining a diversified portfolio. By doing so, you can reduce the risk and improve your potential for returns and achieve financial stability. So now let's move on to the index fund you need in 2026. These index funds are designed to provide broad diversification, low cost, and historical stable performance, making them an attractive option for long-term investors. The first fund is the Vanguard 500 Index Fund. It tracks the S&P 500 index and provides exposure to the US stock market's largest and most established companies. The second fund is Fidelity Total Market Fund Index. You can actually go to their website to confirm all this. Again, this is for educational purposes, so you need to go there and make your own personal research. The Fidelity Total Stock Market Index Fund, which offers comprehensive coverage of US stock markets from small cap to large cap companies. The third fund is the Schwab US Broad Markets ETF, which tracks the Dow Jones US Broad Stock Markets Index and provide investors with exposure to nearly the entire US stock market. Each of these funds has its own unique characteristic pros and cons, but they all share a common goal of providing investors with solid foundation of their investment portfolios. You know, in in the following segments, we'll dive deeper into each of those funds, exploring their features, benefits, and their potential risk. As we do, it's essential to understand the importance of index funds in portfolio. You know, Index funds are designed to track a specific market index, such as S&P 500, and provide broad diversification and low cost. By investing in index funds, you can reduce your risk and increase potential for returns and achieve financial stability. Now, let's move on to the next segment where we explore the Vanguard 500 index fund in details. So, why do index funds matter and how can they help you achieve your financial goals? You might ask yourself that question. To answer this question, let's take a closer look at the benefits of index funds. One of the primary advantages is their low cost because index fund tracks a specific market index. They don't require active management, which means they have lower expense ratios compared to actively managed funds. This can significantly cost savings over a long time. Another benefit of index fund is their broad diversification. By tracking the specific index, it provides a wide range of stock. There are different opportunities which you can get there. In addition, in their low cost and broad diversification, index funds are often less volatile and they are easier to manage. So that's just the beauty of the index fund. So let's just take a minute so that you guys can think well and know what you can actually do in this kind of index fund. Yes, as as I was once a forex trader, I traded a lot of forex things. But what I feel most is that all these they are actually safe to I won't really say safe, but it is easier for you to manage. But take note, all the things I'm saying here is just my view on it. So for you to be able to do anything, you need to make your research on it and confirm it yourself. So you can see all the links right here. You can see all the links right here. You can go there and check the one that best fits what you want to do. And I promise you everything will be cool. So the Vanguard S500 index fund is one of the most popular index funds available for good reasons. It tracks SP 500 index, which is widely considered to be a benchmark for US stock markets. By investing in Vanguard index funds, you will gain exposure to the US market's largest and most reliable companies, including Apple, Microsoft, Amazon, and more. The thing about it is that they are all collaborated in one, which is S&P 500. So you'll be getting advantage from all those companies. So one of the primary benefits is that it has a low cost. You understand what I'm trying to say? It's lower than many of the things you are going to see online nowadays. So the Fidelity Total Stock Index is another popular index fund that provide investors with comprehensive coverage of the US market. You know, This funds track um it tracks the US market, you know, and publicly traded US stocks. So by investing in this, you gain exposure to one range of US stock. You understand what I'm trying to say? So there might be fluctuation, but you're still investing in the US stock. So the last one is this CalWAB US Broad Market ETF. It's a popular index fund which is still the one in the US. By investing in this EFT, you gain exposure to a wide range of US stocks. See, it's all about preference at this point in time because you can just go and see everything yourself. It's all about how you feel about it because they are all so good. How can you actually invest in all those things? You need to open a brokerage account with a reputable online broker, such as the one that I've stated there, the three index fund. Once you have opened the account, you can fund it with your money from your checking or your saving account. Next, you can invest in each index fund, allowing allocating a percentage of your portfolio to each fund. So that's just how easy you can actually invest on all this platform. Why all these things are good to hear. There's some risk, like there might be fluctuation in markets, downturn in the market because currently the market in the US I think is pretty poor right now. So you need to know the risk, and that's just the risk about investments because there will always be a downturn. In conclusion, investing in index funds can be a great way to achieve your financial stability and finally achieve your financial goals. By just be patient and be disciplined, and everything will play out your way. Again, this is for educational purposes, and thank you for watching.